Welcome back. You're still watching The Money Show on ET Now, and in our second segment we have a very exciting discussion lined up as far as the IPO market is concerned. New IPO companies are far worse than index ones in corporate governance. This of course is a study by IIAS that we're referring to right now. Soumya has more key highlights and takeaways of this report. So before we start discussing it with our guests, let me take it across to Soumya. Soumya, can you tell us what were the key findings there?
Yes, that's right, Karan. According to a recent report, poor corporate governance is a key reason for the drag in the returns of the newly listed companies. Talking about this, the time period that I'm referring to is for the 50 companies is between April 15 and March 17. That's 2017. So now talking about this particular, the recently listed companies scored close to about 54 versus 58 for Standard & Poor BSE 100 companies and 61 for Standard & Poor's Sensex companies. Nevertheless, the markets continue to reward the more stable and the better companies. In fact, the auditors raising concerns on financial statements has also increased to 32% versus 24% in the 2018. Now, what's the basis for this scoring? This is on the basis of the following factors: treatment of the shareholders, disclosures, transparency, role of board and stakeholders. These are definitely key when it comes to what the companies are doing, how their performance is, how are their disclosures, where they are transparent, when it comes to their financial statements to the entire stakeholders. Not just this, talking particularly about public sector companies, they had the lowest scoring among the different promoter groups. They scored 52 compared to 62 for private promoter-led companies. Now, what are the key factors that would drag as far as the public sector companies are concerned? First being lack of adequate independent board representation, and the second being lack of transparency on the related party transactions. Not just this, even the multinational companies had the highest score at 63, which definitely tells us that the public sector companies were the worst when it comes to the entire different set of companies that we have, be it private, public or MNCs. So that's the latest trend. Poor corporate governance issues is the key reason that we are seeing a drag in the returns, predominantly for the newly listed companies.
Okay, Soumya, thanks so much for walking us through all the details of this report. Hetal Dalal, the COO of IIAS, that's Institutional Investor Advisory Services. She's joining us right now to talk more about this report. Hetal, hi, thank you so much for taking time out and coming on board. What are the biggest and perhaps the most unexpected findings of the report that you all released recently on the IPO market? Or rather how the IPOs in the recent past have performed?
So thank you for inviting me. One of the things that we looked at when we look at the entire assessment on the corporate governance practices, it's a series of 70 questions and we score them based on publicly available information. So it's a fairly comprehensive way of looking at these companies on their corporate governance practices. In the IPO companies, actually what we found was that the median scores fell from last year. So last year the score was 55, this year it's 54. Also what we found was, while two of the companies that we evaluated last year moved into the index of BSE 100, we also had several failures, and at the tail end, the score had actually dropped. The lowest score had dropped to 29, which we found was surprising, given that usually when we look at companies and if they're checking most of the boxes, you would find that the score is in the region of 45 to 50 at the bare minimum. So a score of 29 is actually very low. So what we are seeing effectively is that, given the fact that this is the past 12 to 18 months have actually been difficult for corporate India, it's really brought out the mettle of their governance practices, and to that extent we've seen that IPO companies don't score as well as the more established BSE 100 or the Sensex companies. Now you would ask why, right? I think one of the big correlations we saw was just in the institutional shareholding. If you look at the median shareholding of Sensex companies, that's around 42%. If you look at it for BSE 100, that's about 34%. But if you look at it for IPO companies and the 50 companies that we evaluated, that's about 24%. So one answer really is that the greater the institutionalization of the shareholding, the more well established or the stronger the governance practices tend to be, and the more compulsion for companies to actually have better governance practices. I'm sorry, you were going to say something.
I just wanted to know what primarily were the drivers or the key reasons because of which many of these companies have scored less this time around.
So if you, and when we look at IPO companies, right, just in terms of the board composition, so how do you look at board composition? What is an appropriate board composition? One is to say that they meet all the regulatory requirements, which is fine, most companies do. I think the larger issue from board composition perspective is, do you actually have independent directors who understand the core domain of the business? If you look at, and this is a lesson we've learned from some of the failures. So if you look at Wells Fargo, for example, one of the lessons from there was the fact that nobody on the board actually understood domain banking. So the first question we ask is, how many independent directors really in IPO companies actually understand the domain of the business? The second question we ask is, do you really have so much of cyber security is becoming a big risk. Kotak committee as well as SEBI has now said that the risk management committees now have to address cyber security risk, and one of the questions we ask is, do you have any kind of IT expert on the board? Now that to me is again a second level issue as far as IPO companies are concerned. If you just look at the board structure, just having someone who understands the domain of the business, who can challenge the management on the assumptions they make for the business is an area which needs significant improvement. So effectively what we are saying is, the boards are run by management far more, and the role of the board tends to be a lot weaker than what we would see in BSE 100 companies and you would see in, let's say, Sensex companies. And this is also structurally from how the companies have grown, right? These are companies which have been driven by entrepreneurs, they are promoter led, they've grown to a certain level, and now they've become listed. And when we talk to companies, a lot of the sense we get is, that becoming listed is really the end game, but actually becoming listed is not the end game, it's just a milestone, and the game completely changes now. And that's really where the institutionalization of good governance practices becomes an important aspect of for IPO companies, and that's something that they need to focus on. So board compositions is one of the issues, but it's a very dominant issue in terms of just in just how the board structure is and what the governance practices are.
The findings as far as the public sector is concerned, because they have the lowest scores among the various promoter groups in the BSE 100 list. They've scored 52 compared to 60 for private promoter-led companies. So why is it that PSUs are so much behind?
So public sector tends to be, in different pockets tends to be the exception to almost every rule. So if you look at just the board composition, having independent directors and just having a board composition which is in compliance with regulation, and several of the PSUs isn't there. When you look at public sector banks, and when you look at PSUs, you look at banks as well as enterprises. So when you look at public sector banks, they breach effectively the minimum public shareholding of 25%, right? Most public sector banks have, the median shareholding of the government of India, if you include LIC, is about 86%. Some of these, so just shareholding is an issue. The government control and the degree of control it has over the PSU and over the board composition is another issue. The fact that you have, the agendas of PSUs also sort of distorted, right? At one level, they have a national policy agenda to follow, and which is true for all state-owned enterprises, leave aside Indian PSUs. It's really an issue with all state-owned enterprises. So you have a national agenda to follow. At the same level, you also have an agenda of getting returns for shareholders, and these two don't always talk to each other. So these are sort of contradictory agendas that PSUs have. So PSUs, the other issue is just the regulation which creates exceptions for PSUs. Related party transactions is an important element of this entire assessment, and that's usually the area that you look at for promoter-led companies, because that's
right.
That's an area that investors
Hetal,
believe
one
creates
follow
the
up.
greatest financial leakage. But when
I just wanted to follow up, Hetal, can these corporate governance issues, public sector or private, can they hurt risk?
I'm sorry, I didn't hear you. Can they hurt?
Hetal?
Yeah, I'm sorry, I didn't get the question.
I'm
Can you
trying
repeat
to,
that, please? I
I'm
wasn't
trying
able
to
hear you clearly.
understand to what extent can they hurt the risk appetite when subscribing for IPO, corporate governance issues, irrespective of private or public sector.
So when you look, so when we did an assessment of just a correlation between price performance and corporate governance levels, right? At a portfolio level, companies which are well governed tend to outperform the residual portfolio just in terms of price. We've done this test for 3 years and we've done it for 2 years. So when you look at it, the corporate governance levels tends to be to that degree a predictor. The other correlation you see very strongly is with stock beta. So there is an inverse correlation. So better governed companies tend to have lower stock beta, which is basically stock volatility, vis-a-vis companies which are not well governed. So when you're looking at governance practices from an investor standpoint, there is a risk that you run as far as price movement is concerned and as well as stock beta is concerned. Again, when I say this, it's at a portfolio level. You will always have exceptions to every rule and there will be individual companies which may not follow the trend, but at a portfolio level, this is generally true that well governed companies have, in terms of just the assessment that we've done, have actually outperformed on price and have lower stock beta.
As as the market that we stand in right now, what are the risks of investing in an IPO?
So I can't make really comments on under SEBI regulations. I'm prohibited from making comments on price and valuations, but I can make a comment on just the governance practices. I think for investors, while you look at what is the multiple and whether it's good or bad or it's overly priced, I think one of the things you need to look at if you're going to be a long-term investor is really what are the governance practices and what is the kind of management and board that the company has. Usually companies which scored well on even in the bucket of IPO companies were companies which are either subsidiaries of large institutions and sort of well established, those with well established governance practices vis-a-vis the residual. At the tail end you will also see failures. So a lot of it rests on what that kind of structure is and what is the balance between the board and the management from a governance standpoint. I think the other thing to look at is the degree of related party transactions. There is one view in global markets, there is a view which says why should a company have related party transactions at all? And given the nature of the Indian markets, that about 2/3 of the companies are promoter controlled, you would naturally look at related party transactions. But the degree and the rationale of these related party transactions tend to be a telling sign of how the company is actually being managed and where the possible leakages are. And these, I think, would be the two big things to look at.
All right, Hetal, thank you so much for joining us for this conversation about the risks of investing in the IPO market, given how the statistics are what they're indicating at this juncture. IIAS also has done a very detailed report with respect to that. Thank you once again, Hetal. Let's slip into a short break once again. When we come back, we'll talk more about personal finance on the other side.